Some people say the oil and natural gas industry benefits from taxpayer subsidies. Well, nothing could be further from the truth. Rather, the industry enjoys deductions and various cost recovery mechanisms just like any other industry does. Deductions are fundamental to our tax code, and all industries are allowed to take deductions. For example, if you own a bakery, you purchase sugar, eggs, flour, milk, all of these things to make your products. You also employ individuals, your bakers and your cupcake makers, the various employees of your industry. You're able to deduct not only the costs of the goods that you produce to run your business, you're also able to recover the costs of the salaries of these employees. Now, what you do with these deductions and cost recoveries are you plow them right back into your industry in high-paying wages, or you reinvest them into the economy. The exact same is true with the oil and natural gas industry. Currently, all industries who use the Section 199 deduction get it at 9%. If you make tea or coffee in the United States, even if you're grinding imported coffee beans here in the U.S., you get a 9% deduction on that activity. If you're a baker and you manufacture cupcakes here in the United States, you get a 9% deduction on that activity. However, if you're an oil and gas company, you only receive a 6% deduction on your qualified activity here in the U.S. Now, that's one example where you have a broad provision in the tax code that is, one, not a subsidy, it's not a credit, it's not a grant, it's not a gift, it's a legitimate business deduction available to all industries. Cost recovery is a fundamental part of the net income tax system that we have here in the United States, and it allows industries to reinvest those costs back into high wages, new technologies, expanding their business, etc. One of the domestic ways that our industries recovers costs is through the Intangible Drilling Cost Deduction, also known as IDC. Fundamental principle of this provision is found all throughout the tax code. For example, if you are a research firm developing a new microchip, it's very uncertain if that's going to work or not, and so you spend millions, sometimes billions of dollars in scientists' salaries developing this new technology. Now, at the end of the day, all of that money you spent to develop this microchip in the salaries of the scientists, labor costs, etc., you're able to deduct in the first year. You can recover 100% of those costs in year one. The same thing happens with the oil and natural gas industry. In our development process, 60 to 80% of these costs are labor costs, the costs associated with the actual manual labor and the engineering of drilling a well. Now, these costs, if you're an independent company, just like the example I gave of the tech firms, you can recover 100% of those costs in the first year. However, if you're a major integrated oil or natural gas company having both upstream and downstream operations, you're only able to recover 70% of those costs in the first year. You're forced to amortize the rest over a 5-year period. Now again, you have an instance where a provision that exists all through the tax code, cost recovery, is treated differently with respect to the oil and natural gas industry than all other industries. Specifically, this IDC provision was put into the code at the inception of the tax code in the early 1900s. So it is in no way a special gift, a credit, a loophole, or a subsidy. It's simply the way our industry recovers our labor costs, and labor cost recovery of all kinds is fundamental in our current net income tax system. For more information, please visit energytomorrow.org and follow us on Twitter @EnergyTomorrow.